So, you're thinking about investing in an off-plan property. Let me guess. Someone showed you a glossy brochure with CGI images that look like a luxury hotel, promised you guaranteed returns, and told you to get in early before it's too late. Well, buckle up, because I'm about to tell you what that brochure conveniently forgot to mention. Here's the most important thing you need to know. Off-plan investment in the UK is currently an unregulated industry. Let that sink in. Unregulated. That means if you don't get what you're sold, there are no laws to protect you. And here's the kicker. Property investors aren't covered by consumer law. So once you've exchanged contracts, you're legally bound to complete, no matter what happens. Or you lose your money. Plus legal costs. Fun times, isn't it? Google off-plan risks in the UK right now. Go on. You'll find there is a risk that a property bought off-plan may be completed late, may not be completed as planned, or even may not be completed at all. Still excited? Great. Let's dive into the wonderful world of off-plan investing. But before I begin, I must say viewer discretion is advised. This video contains information of financial heartbreak, unrealistic yields, and an alarming amount of unregulated enthusiasm. Proceed with caution, preferably with a regulated financial advisor. So let's begin. First up, the reservation fee, or as I like to call it, the foot in the door that might cost you thousands. Before you hand over a single penny, demand to see the terms and conditions. Check if it's refundable or non-refundable, because spoiler alert, it's usually non-refundable. Also, check your consumer rights. Under what circumstances can you actually claim that money back? Oh, and there's something called a statutory cooling-off period of 14 days. Make sure you know exactly how that works before your money disappears into the developer's account. Now let's talk about your personal financial circumstances. Because here's the thing, you need to have enough cash reserves to handle every possible disaster scenario. And trust me, there are many. First disaster, you can't get a mortgage. Why might this happen? Well, let me count the ways. Stress tests. Most buy-to-let lenders require you to have a minimum income depending on the amount of lending. They want to know you can still pay your mortgage if everything goes wrong. And if you're investing through a limited company, these stress tests are even stricter because interest rates are higher. Investor-led developments. Mainstream lenders think these are high risk, so they won't touch them. The specialist lenders who will. They charge much higher fees. And once they hit their lending threshold, good luck finding another one. Are you a new landlord? Because some lenders only lend to experienced landlords. Unsuitable property. More on this later, but if the property doesn't meet certain criteria, lenders won't finance it. Can you try different lenders? Sure, but each valuation costs money. Second disaster, down valuation. This is a big one. The property might be worth less when it's completed than when you exchanged. Why? Market changes. Or, and this is important, the developer inflated the price to begin with. Off-plan properties often carry a build premium of 5% to 30% higher than market value. That's not me being cynical, that's just how it works. When completion rolls around, the surveyor looks at comparable properties in the area and goes, yeah, this isn't worth what you paid. Suddenly, you need to find an extra 10% or more to make up the shortfall. Oh, and those undesirable lease terms. Like a 99-year lease instead of 125 years. That'll knock the value down too. Third disaster, less than 75% loan to value. Even if you get a mortgage, the lender might only offer you 65% loan to value instead of the expected 75%. Guess who's paying that extra 10%? You are. Fourth disaster, additional legal costs. Mistakes happen. Delays happen. Solicitors, mortgage lenders, surveyors, they're all human. And all these delays mean more legal fees for you. Here's the cruel irony. With a normal property purchase, you exchange contracts after you've secured your mortgage. With off-plans, you exchange long before you can even apply for a mortgage. You can only apply when the property is fully or nearly fully constructed. Only then will the lender provide a market valuation based on comparables. So you're committed before you know if you can actually afford to complete. Brilliant system, right? Let's talk about the developer. After all, this is the company you're trusting with tens or hundreds of thousands of pounds. First, make sure they're registered and regulated by the appropriate authority. Agents must be part of a redress scheme like the Property Redress Scheme or the Property Ombudsman. Developers should ideally be registered with the New Homes Quality Board. Ask where your money is going. Is it held in a client account? Or is it going straight to the developer to fund construction? Because if it's the latter and the developer goes bust, your money goes with them. Speaking of which, what happens if the developer goes bust? Ask about their insurance. Will your money be protected? Also, ask about their warranty provider. This is the insurance policy that supposedly guarantees the building is constructed to high standards. Now do your homework. Check company's house. Look at their financial statements. How long have they been in business? Run a background check on the directors. What other properties have they built? Read reviews. Did they actually deliver what they promised in those glossy marketing brochures? Did their previous projects complete on time, or were there severe delays? Because here's a little secret, delays are incredibly common. Now, the property. The thing you're actually buying. Novel concept, I know. Request the plans and specifications so you know exactly what you're getting in terms of size and location within the development. Check comparables. What are similar properties in the area selling for? Make sure you're not overpaying from day one. Check the surrounding area. Is your luxury apartment next to an industrial unit? Is it inside a commercial building? Does it overlook a motorway, or is it backed into a prison? These are just a few examples. Because the surrounding area will have an impact on the mortgage valuation, you might want to pay for an independent survey before exchange to avoid the nightmare of being unable to get a mortgage at completion. The exchange contract. A lovely thick document full of legal jargon that most people don't understand. Let's break down some key points. Assignable versus unassignable. Can you sell the property before completion? Make sure you know. Short stop date versus long stop date. The short stop is when you are told completion is due. The long stop is the latest possible date, usually 6 to 24 months later. Assume it'll be closer to the long stop date. So if you are remortgaging your home to release equity for this investment, you could be paying interest for years before your new property starts generating an income. Now, here's something crucial. Conveyancing and legal advice are two separate things. Some conveyancers aren't trained to give you legal advice or spot clauses that aren't in your interest. You need an independent solicitor who understands off-plan investments and will actually look after your interests. Why? Because the exchange contract is full of clauses that are inclined to favor the developer, not you. For example, the developer reserves the right to make changes to the contract before completion. Here is another one. The buyer shall not rely on any marketing or sales representations made at the time of purchase. Translation: everything they told you might be lies, and that's totally fine. Check what you're allowed to do with your property after completion. Can you sell it immediately, or do you have to wait 2 to 5 years? Are you allowed to do short-term lets? Is it private residential use only, meaning you need consent to let? If you're planning to rent to a company tenant or use a rent-to-serviced accommodation model, that'll require additional legal fees every time you modify or extend the tenancy agreement. And let's talk about service charges. Oh yes, the gift that keeps on taking. Check the estimated annual service charges and ground rent. Are they fixed, or can they escalate? Some leases have clauses that allow service charges to double every few years. You might think you're getting a great rental yield, but once you factor in service charges, ground rent, and maintenance fees, your profit can evaporate. Get clarity on what's included, who manages the building, and whether there's a sinking fund for major repairs. Because trust me, those bills will come. Up until exchange, you can negotiate or walk away. After exchange, you're legally bound to complete or lose everything. Finally, let's discuss market conditions. Because a lot can happen while you're waiting for your property to be built. Construction timelines are uncertain. The property market can fluctuate wildly. Mortgage interest rates can rise or fall. If they rise, your mortgage payments increase and lenders might lower the loan-to-value from 75% to as low as 50% to 55%. Suddenly, you need way more cash to complete. Check the rental market. Are you investing in a city oversaturated with new developments? When an entire development releases hundreds of apartments at once, rental income plummets because everyone's competing for the same tenants. The market is volatile. Think about COVID. Think about Brexit. Recession, market crashes, inflation, soaring interest rates, falling property prices. All of these can happen while you wait. And remember, you're committed long before the property exists. Off-plan investments can work. If you have a large pot of cash earning nothing in the bank, and you're confident the property will appreciate by completion, it might be a good move. But you need to go in with your eyes wide open. Do your due diligence. Check every party involved is registered and regulated. Read every contract clause. Have enough reserves to handle any shortfall. And for the love of all that is holy, get proper legal advice from a solicitor who specializes in off-plan investments. Because this is an unregulated industry, and if things go wrong, you're on your own. Don't say nobody warned you. Final disclaimer. This video is for learning, not for signing contracts in a hurry. Off-plan investments are unregulated and can be riskier than they look in the glossy brochure. Do your homework, ask hard questions, and never confuse a CGI render with reality. Think smart, invest wiser, and keep your wallet out of fantasy land.